Friends, today I'll talk about derivatives. If you think about derivatives, so primarily, there are different underlying products which are there, and we have derivatives for each of them. Like we have equity, which is very common commodity. Then you have currency pair derivatives, and you also have interest rate derivatives. So these are primarily, the four different classes of derivatives. And who are the participants? One participant is, of course, people who take hedge or who hedge, their positions. Basically, these are maybe exporters or importers who are dependent upon earnings in foreign currency, and they might be getting their payout after a few months. So in case of variation in currency, they get impacted. So these are the hedgers. So apart from people who hedge, there are the normal traders who take long term or short term view in terms of the movement of the underlying product and take long or short positions. And we also have another type of people which is who take arbitrage position, right? So they can buy in cash segment, and for the same product in the derivative segment they sell, and they gain basically the difference between the two, and this is a risk free gain. So these are the three different types of participants in the derivatives market, right? And now if you look at the insurance companies, they of course hedge in terms of the interest rate bit, so that they can capitalize on a higher interest rate for a longer period. So because the tenure is very high, maybe 15 years, 20 years, so it makes good sense for them also to take position over there, right? But in terms of the normal mutual fund route, or the normal route, it becomes very difficult for an investor to keep track of so many things, and when to take position and when not to, because ultimately it involves very high risk if you are a trader, right? Now there are certain strategies which are in place for range bound market. When there is no direction, it goes from one range, from the lower part of the range to the upper part of the range, or maybe when the direction is not clear, there are certain strategies like you have straddle, you have butterfly. In option you have call and put, so you can buy and sell at different strike prices, or maybe in different contract months, and this gives you a stable return, right? So this is something which has been incorporated in the specialized investment fund. So over there the fund manager takes position and gives you a stable gain. So this is a good usefulness of it. So hope you like my video and use specialized funds.